Hello everyone, this is Sebastian McMahon from IA Financial Group. I'm back with another weekly edition of the Weekly Economic Review, this time for the week ending December 17, 2021. So a busy week. We're back with some restrictions on COVID, especially in Quebec, but we're seeing more also around the country. We're seeing some around the world. So we're going to be making sense of everything that happened this week right now. Okay, so a typical risk-off week on the markets. Negative week for stocks. It's TSX, S&P 500, Nasdaq, especially emerging markets, all down on the week, and bonds up. That means interest rates down. So typical risk-off week. Canadian dollar lower. 1.96% for the long index. So that's a very good week. Year to date, still negative on bonds, but we're getting closer to neutral compared to where we were at some point in the year. And unless we have a spectacular turn of events, the S&P 500 is headed towards coming ahead of the TSX for the year, 26.5% now in Canadian dollars compared to 22% for the TSX. Euro up, price of gold up, price of oil up, but still very risk-off week. So very, very sadly, I need to bring the COVID charts again. So Omicron is causing some issues around the world and new measures to make sure that we don't overcharge the hospital system. So we're back to this square. So on the left, you have developed countries, so OECD countries, new cases, new deaths in Europe and North America. Cases, as you can see, we're almost at the highest level on the record, and the acceleration we've seen in Q4 has more to do, or almost everything to do, with the Delta variant. Omicron is very new, so we should expect these figures to go up. Deaths, you can see the impact of vaccines in the data. Deaths are not following cases, but we're hearing stories about people going to a restaurant and almost everyone coming out testing positive for Omicron. So that tells you how contagious this thing is. So expect a tough few weeks ahead. I'm no doctor, but this is what I hear. So hospitalizations on the right. So Canada, the dark the red line. You're seeing still not seeing an uptrend. We are seeing an uptrend in Quebec. It's all about hospitalizations. You want to protect the hospital system. So right now, so far so good, but these charts will be very important to follow over the next few weeks and months if Omicron spreads as everyone expects. So inflation, I need to talk about inflation again because we had inflation figures for Canada this week. This is the long-term picture, so the highest since the 1990s in Canada, highest since the 1980s in the US. The good news is that it starts to look like maybe we're seeing the top for the pace of inflation in Canada. It's still very early to tell. With Omicron, we could have impacts on the supply chain that could be causing some issues. So we need to keep this level of uncertainty around every forecast that we make right now. But 2 months in a row where we're close to 4.7% year over year, so 4.67 I think in October and 4.72 in November. So that's why you see the line going up a little bit. But we're still we're seeing at least that the peak is not accelerating as it was prior. So transportation costs, the orange shaded part, are important again, but maybe if you just starting to do the math here, the base effects, so meaning the year-over-year comparison, because when you look at inflation figures in the media, remember that it's the comparison between the price level now. So here it's for the inflation that we just saw was for November 2021 compared to the price levels that were November 2020. So let's make the exercise here with the average price of gasoline, which is an important component of CPI. A good part of the household spending is in gasoline because everyone needs to put gas in their car, at least if you don't have an electric car. And the price of gasoline impacts prices of many other things like food through transportation. So if you look at here, you have a 5-year of data. You can see it can be volatile, but look at how quickly the prices accelerated in early 2021. So as we'll move into spring, so let's say March, April, May, as you can see, the year-over-year effects, you won't be comparing to prices that were almost the most deflated post-COVID, like recently. So the prices of gasoline in November, October of 2020 were at the lowest post-COVID. You'll start to be comparing to prices that are way higher. So recently, price of gasoline about 150. Late 2020, it was 105, somewhere like that. So that's almost 50% inflation. But unless we have gasoline prices booming again, but our base case scenario is that it's not going to happen. Probably we could see some uptrend. But you can also see this going sideways. So we don't really know exactly where the price of gasoline will be. But I think it's fairly unlikely that we'll see this kind of boom, which was caused more about the economy reopening. So right now, we're not really talking about reopening. We're talking about shutting things down. So we could see very quickly that the year-over-year effects become much less positive, and that pushes the inflation rate lower. So inflation, we expect it to be lower at the end of 2022. Exactly how low? It's too early. There's just so much uncertainty right now. It could be between 2.5% and 3.5% in this vicinity. But I mean, there's a historical level of uncertainty around this. But we do think that inflation could be lower in 2022 than what we are seeing right now. So this is to be followed. Supply chains, early signs that it's getting better. So we're seeing some regional surveys in the US. This one comes from the Federal Reserve of New York. So all of the regional offices have surveys of businesses. And among the questions that they ask are, well, how are the prices that you pay as a business and the delivery times? And as you can see on the left, you can see that prices paid, well, at least it's not getting worse. So prices paid remain very elevated, but they're not going higher. So is it an early sign it is getting better? Maybe. So we'll take it. We'll see how it evolves. But on the right, the delivery time. So how long does it take before you get the orders that you had that you ordered? The things that you ordered, so it starts to move lower. So again, it's too early to say that there is a clear trend here, but maybe we have some early signs that it's getting better. With Omicron, it's still a big question mark, but 2022, the year of the great uncertainty. So you had the year of the virus in 2020, the year of the vaccine in 2021, now 2022, I would label it the year of the great uncertainty. Now, financial markets this week, we had the Federal Reserve is a bit more worried about inflation, so it didn't hike rates. It accelerated the tapering or the phasing out of its bond purchases in the market. So it's printing less and less money every single month to buy bonds, and it's a good thing. We need to phase that out. We don't really need that with all of the data that we're seeing. The economy is strong enough to phase that out. And they are seeing now that they could be hiking in 2023 at a pace that is faster than what they expected before, because the Fed, contrary to the Bank of Canada, they produce a forecast of where they think their rates will be at the end of each year. So it's kind of they're forecasting their own behavior. And they used to forecast that in 2023 they would be hiking once, and now they changed that to 3 times. The market thinks 2, so 2 to 3 hikes. So in the US, same thing in Canada, we should see rate hikes in 2022. They're coming, so that means that your lines of credit will be more expensive. If you have a variable mortgage, the rate will be moving higher. If you need to sign for a new fixed rate mortgage, it'll cost more in 2022 than in 2021. So this is all coming, so you can prepare for that. But the question is, how quickly will this happen? Well, there's a lot of uncertainty surrounding that. But if we go back to the financial markets to close this review, if you invest in bonds right now, well, the Fed says that it expects to be at 2.5% on the leading rate in 2025. That's the star. And the markets, the gray line, they're saying, well, we think we'll be more somewhere below 2% in 2025. So there's a gap here. It's like the market says, yes, you need to hike rates now, but probably you won't be able to hike as much as you think, because maybe inflation won't be as present, or the economy is not going to be strong enough. So it's interesting. We'll see how it happens, but we could be in for a few surprises on monetary policy in the next few years, because there's so much uncertainty right now. That kind of sums it up. So ia.ca/economy, if you want to follow us, Economy and Finance 101, you can always go there. There will be some new material in 2022 there. You can follow us on Twitter. Yeah, you can connect with me on LinkedIn, and this presentation will be available in PDF format on my LinkedIn page. So connect with me or just do a search for me and you'll find it very easily. So next week, a special week, a year in review edition of the review will be published on Thursday, December 23rd. So I'll see you there. Thank you.